The long-term capital management disaster, when Nobel laureates broke the cardinal rule of risk. In the mid-1990s, a new kind of hedge fund opened its doors in Greenwich, Connecticut. It wasn't just another investment firm. It was envisioned as an institution, a financial machine built by the finest minds of a generation. On its board were men who had literally written the textbook on modern finance. This firm was called Long-Term Capital Management, or LTCM. It was founded by John Meriwether, a legendary bond trader from Salomon Brothers, and its partners included Myron Scholes and Robert Merton, who would soon share the Nobel Prize in economics for their groundbreaking work on pricing financial risk. They were, by any measure, the smartest people in the room. Their goal was to apply academic rigor to the messy world of the market, using complex mathematical models to identify and exploit tiny inefficiencies. They believed they could generate high returns with seemingly low risk. For a time, they were fantastically successful, attracting billions from the world's most sophisticated investors. But within 4 years, this collection of geniuses would bring the global financial system to the brink of collapse. Their story is a cautionary tale about leverage, hubris, and the flawed assumption that human behavior can ever be perfectly modeled. It is the story of what happens when the cardinal rule of risk is not just broken, but ignored entirely. The strategy that powered LTCM was a form of arbitrage, specifically convergence trading. The core idea was simple. The fund's computer models would scan global markets for pairs of securities whose prices were historically linked but had temporarily drifted apart. A classic example involved U.S. Treasury bonds. A newly issued 30-year bond might trade at a slightly different price than a 29.5-year bond, even though they were nearly identical. LTCM would buy the cheaper one and sell the more expensive one, betting that their prices would eventually converge. The profit on any single trade was minuscule, often just a few cents on the dollar. But the partners at LTCM believed these were near certainties. Their models, built on decades of historical data, showed that these price gaps almost always closed. The key was to make these trades on a colossal scale. To achieve that scale, the fund relied on leverage. For every dollar of capital invested by its partners and clients, LTCM would borrow $25 to $30 more from major banks. This immense borrowing magnified the tiny profits from each trade into extraordinary returns for the fund's investors. In its first full year, 1995, LTCM returned over 43% after fees. The next year, it returned 41%. The fund was a phenomenon, a testament to the power of quantitative finance. It seemed Meriwether, Scholes, and Merton had built a money-printing machine that had tamed the irrationality of the market. The firm's prestige and early success created an aura of invincibility. The minimum investment was $10 million, and its client list was a roster of the world's financial elite. Major Wall Street banks lined up not just to invest, but to lend LTCM the vast sums it needed to operate. They saw the fund as a source of easy fees and believed its risk was managed by the best minds in the business. LTCM's models were the heart of its operation. They were designed to calculate risk down to the decimal point, based on the historical volatility and correlation of thousands of different assets. The partners believed they had diversified their bets so widely that a major loss in one area would be offset by gains in another. The system was built on a core assumption of modern finance, that markets, while sometimes erratic, would ultimately behave rationally and revert to historical norms. The risk models assigned an infinitesimally small probability to the idea that all of their diversified positions could lose money at the same time. At its peak in 1998, LTCM managed approximately $4.7 billion in investor equity. But through leverage, it controlled over $125 billion in assets. More astonishingly, its off-balance sheet derivative positions had a notional value of over $1.25 trillion, an amount equivalent to nearly 5% of the world's total economic output. The first sign of trouble appeared in 1997 with the East Asian financial crisis. Currencies and stock markets across the region plunged, creating volatility that rippled through global markets. LTCM's models registered the event as a statistical anomaly, a Six Sigma event that shouldn't happen in thousands of years. The fund incurred losses, but the partners remained confident that markets would soon return to normal. Instead of reducing their risk, they saw the widening price gaps as an even greater opportunity. They doubled down on their convergence trades, believing the eventual snapback to normalcy would be even more profitable. For the year, the fund still managed the positive return of 17%, but the seeds of disaster had been sown. The true cataclysm began on August 17, 1998. On that day, the Russian government devalued its currency, the ruble, and defaulted on its domestic government bonds. For the financial world, this was a seismic shock. It was an event that many risk models, including those at LTCM, had considered a virtual impossibility. The Russian default triggered a global panic. Investors everywhere engaged in a massive flight to quality. They indiscriminately sold assets perceived as risky, like corporate bonds, mortgage-backed securities, and emerging market debt, and poured their money into the safest assets on Earth, primarily U.S. Treasury bonds. This mass movement of capital was the exact opposite of what LTCM's strategy was built on. Instead of converging, the price gaps between the assets they owned and the assets they had shorted widened to unprecedented levels. Every one of their carefully diversified positions began to lose money simultaneously. The fund's models were breaking down because they were based on a world of rational actors and normal market conditions. They could not account for the sheer force of collective human fear. The historical data on which the entire enterprise was built had become irrelevant overnight. The losses were catastrophic and terrifyingly swift. In the month of August 1998 alone, long-term capital management lost $1.85 billion, representing 44% of its total capital. The supposedly low-risk money machine had become a high-speed wealth destroyer. The fund's massive leverage now became its executioner. As the value of its assets fell, its lenders, the very same Wall Street banks that had eagerly financed its rise, began issuing margin calls. They demanded more collateral to back the enormous loans, but LTCM was running out of cash. To raise cash, the fund needed to sell its assets. But here they faced another critical problem. Because LTCM was so large, and because many banks had copied its popular trades, the entire market knew what positions it held. When LTCM tried to sell, potential buyers vanished. No one wanted to buy assets that a collapsing giant was desperately trying to unload. Worse, rival trading desks at other banks began to trade against LTCM, a practice known as front-running. Knowing the fund would be a forced seller, they would short the same assets, driving prices down further and exacerbating LTCM's losses. The markets had become a trap with no exit. John Merriweather scrambled to find a savior. He flew around the world, seeking a capital injection that could stabilize the fund. A potential rescue package was put together by a group including Warren Buffett, Goldman Sachs, and AIG. They offered to buy out the fund for a mere $250 million and inject $3.75 billion in new capital. The partners at LTCM, still believing in the ultimate validity of their positions, rejected the offer as insultingly low. They felt their trades would eventually pay off if they could just hold on long enough. It was a final act of hubris from a team that had lost control. By mid-September, the situation was untenable. LTCM was days, if not hours, from a complete collapse. The fund had lost over 90% of its equity since the start of the year. But the problem was no longer just about one hedge fund. It had become a systemic threat. The New York Federal Reserve, led by its president William McDonough, began to watch with increasing alarm. LTCM was so deeply intertwined with every major global bank, acting as a counterparty on tens of thousands of derivative contracts, that its failure would not be an isolated event. If LTCM defaulted, banks around the world would be exposed to massive, unknowable losses. The credit lines that lubricate the global economy could freeze. The fear was that the fund's collapse would trigger a chain reaction, a domino effect that could destabilize the entire financial system. This was the essence of systemic risk. McDonough and his team concluded that they could not allow a disorderly bankruptcy. The failure of LTCM was not the primary concern. The collateral damage it would inflict upon the global economy was. The fund had become, in effect, too big, or more accurately, too interconnected to fail. On September 23, 1998, the New York Fed took an extraordinary step. It summoned the chief executives of every major Wall Street investment bank to its headquarters in Lower Manhattan. The invitation was not optional. The scene inside the Federal Reserve was one of unprecedented tension. The heads of Goldman Sachs, Merrill Lynch, J.P. Morgan, and a dozen other rival firms were gathered in a single room. They were competitors, but they were now faced with a collective problem that threatened them all. The Fed made its position clear. It would not use public money to bail out the hedge fund. However, it would facilitate a private sector solution. McDonough effectively locked the doors and told the bankers they were not leaving until they had agreed on a plan to rescue LTCM and, by extension, themselves. The negotiations were fraught with conflict. Some banks, who had less exposure, were reluctant to contribute to a bailout that would save their more exposed rivals. Bear Stearns, for its part, refused to participate at all, arguing it was not their responsibility to save a mismanaged fund. But the fear of systemic collapse was a powerful motivator. As the hours ticked by, a consensus emerged. A consortium of 14 banks agreed to inject $3.625 billion into the fund. In exchange, they would take control of 90% of its equity and oversee its orderly liquidation. This was not an act of charity. It was a calculated act of self-preservation. The banks were bailing out their own counterparty to prevent a catastrophic cascade of losses across their own balance sheets. The original partners of LTCM, including the Nobel laureates, were virtually wiped out. With the new capital injection, the consortium took control of LTCM's portfolio. Over the next year, they carefully unwound its vast and complex positions. As global markets slowly stabilized, many of the fund's convergence trades did eventually prove to be profitable. By the time the fund was fully liquidated in early 2000, the bailout consortium had been paid back in full and even made a small profit. The immediate crisis was averted, but the LTCM affair left a deep and lasting scar on the financial world. It prompted intense scrutiny from regulators and lawmakers. In congressional hearings, Federal Reserve Chairman Alan Greenspan defended the Fed's role, arguing that its intervention had been necessary to prevent contagion. However, the bailout raised profound questions about moral hazard. By orchestrating the rescue of a reckless private firm, had the Fed sent a dangerous message to the market? The message seemed to be that financial institutions could take enormous risks, and if those risks threatened the system, authorities would step in to prevent the worst consequences. The legacy of long-term capital management is complex. It was a stunning intellectual failure, a demonstration that even the most sophisticated mathematical models are vulnerable to the raw power of market panic. It proved that historical data is not a perfect guide to the future, especially when it comes to rare black swan events. The cardinal rule that LTCM broke was not a mathematical one. It was a fundamental misunderstanding of risk itself. The partners believed that risk could be precisely measured, managed, and diversified away. They failed to appreciate that in a true crisis, all correlations go to one. Everything falls together. 10 years later, The lessons of LTCM would echo with chilling familiarity during the global financial crisis of 2008. The concepts of excessive leverage, interconnectedness, systemic risk, and institutions being too big to fail would return on a much grander scale. The bailout of LTCM was, in many ways, a dress rehearsal for a far greater storm to come.